Mastering business interruption insurance. A hurricane or earthquake can trigger business interruption insurance to rescue your business from devastating financial loss. Which circumstances would trigger business interruption insurance to respond to a natural disaster, such as a hurricane or earthquake, and what specific steps would its response entail to mitigate its impact on a business's operations and revenue? Business interruption insurance is a type of insurance policy that provides financial support to businesses when they suffer a loss of income due to an unexpected event, such as a natural disaster like a hurricane or earthquake, that disrupts their normal operations. The policy kicks in when the business is forced to suspend or reduce its operations due to physical damage to its premises, equipment, or inventory, resulting in a loss of revenue. There are specific circumstances that would trigger a business interruption insurance policy to respond to a natural disaster. 1. Direct physical damage. The natural disaster must cause direct physical damage to the business's premises, equipment, or inventory, making it impossible to continue operations. 2. Interruption of business. The business must be forced to suspend or reduce its operations as a direct result of the physical damage, leading to a loss of revenue. 3. Covered peril. The natural disaster must be a covered peril under the policy, such as a hurricane, earthquake, or flood. Once the policy is triggered, the response of the business interruption insurance entails the following specific steps to mitigate the impact on the business's operations and revenue. Step 1. Notification and assessment. The business must notify the insurer of the loss, providing detailed information about the damage and disruption caused by the natural disaster. The insurer will assess the damage and determine the extent of the disruption to the business. Step 2. Interruption period. The insurer will determine the length of the interruption period, which is the duration of time the business is unable to operate due to the damage. This period is used to calculate the business interruption losses. Step 3. Business interruption loss calculation. The insurer will calculate the business interruption loss, which includes the following. Gross profit. The insurer will calculate the business's gross profit, which is the difference between the business's turnover and the cost of goods sold. Loss of gross profit. The insurer will calculate the loss of gross profit due to the interruption, based on the business's historical financial data. Continuing expenses. The insurer will identify the continuing expenses that the business is still incurring, despite the interruption, such as rent, utilities, and salaries. Step 4. Payment of benefits. The insurer will pay the business interruption benefits, which are calculated as the loss of gross profit, plus continuing expenses, less any savings or reductions in expenses resulting from the interruption. Step 5. Support and assistance. The insurer may provide additional support and assistance to help the business recover from the disaster, such as claims adjuster. The insurer will appoint a claims adjuster to work with the business to assess the damage and calculate the loss. Recovery planning. The insurer may provide guidance on recovery planning, including advice on how to mitigate further losses and restore operations. Emergency funding. The insurer may provide emergency funding to help the business cover urgent expenses, such as repair costs or temporary relocation. By providing financial support and assistance, the business interruption insurance policy helps minimize the impact of a natural disaster on a business's operations and revenue, enabling it to quickly recover and resume normal operations.